Hey, Matt, did you ever start a business on your own?
You know, we're doing a podcast called A Dictionary of Finance. You think I'd have lots of business ideas, but actually I don't. Did you ever start a business?
Well, sort of. I think when I was about 7, I started my own newspaper called The Palm Tree. But that didn't really go anywhere.
Why, because they don't have a lot of palm trees in Estonia?
I'm not sure that was the reason, but maybe the reason was that I didn't really know anything about venture capital or elephants.
Elephants? What's it got to do with elephants?
Well, here's Uli Grabenwarter, who's Deputy Director of Equity Investments in the European Investment Fund, which is part of the European Investment Bank Group. He deals...
I'm waiting for the elephant.
He deals with venture capital.
Uh-huh.
He has investments in technology and innovation.
And elephants.
And I'm sure Palm Tree newspaper would have been innovation. Well, the elephants you have to ask about from him, because you see this whole office is filled with photos and pictures of elephants.
But why the elephants? You have elephants up on the wall here. You have, 3?
Elephants, that's a relatively funny story, because I invented my own elephant at the age of 13, who, given my name, is called Ulifant. My first name is the kind of short version is Uli, and I created Ulifant in the Latin lessons. Because I was so bored about translating Hannibal crossing the Alps with the elephants that I decided I needed to do something more creative while we were translating that stuff, and I created the Ulifant, and that got me really going on elephants, and I somehow...
You stuck with them.
So your elephant was an improvement on the original elephant? Or?
It was not an improvement, but it was a kind of marketing line for a time. I had products, sweaters, kind of caps and... pens and socks, even underwear.
Let's start by stepping back and saying, what is venture capital?
Well, venture capital basically is risk capital that is there to finance innovation. And now probably you will add up the next question, which is, what is risk capital? And risk capital basically is a form of capital that steps in wherever a normal bank would not touch the counterpart because it's too risky. And so it's the kind of money that you need and that you get from venture capital investors in order to really fund disruptive things for society that actually push forward innovation. So it's not about kind of launching the next bakery, but it's about funding new molecules in biotechnology that eventually lead to new medications and things like that, or new technologies like today we use Skype and technologies like that, which all have in the beginning been funded by venture capital.
And specifically Skype also being funded by the EIF as well, right?
That's correct. We have been in a fund that has been one of the founding funders of.
But the reason why venture capital and risk capital is not looking to fund the bakeries is not just not just because we want to improve the world, but it's also a financial one, right? Because the bakery, the chances of a bakery returning the money tenfold or 100-fold are very slim, right? So we need that disruptive technology to increase the chances that the money will really pay off well.
Yeah, I wouldn't put it because of the return multiple. It's a different risk profile. On a bakery, if you've got some commitment of somebody who is trained to do that, you would have probably people around that very easily buy into the risk of setting up a bakery, because you've got probably 50 families living around that bakery that can be the natural clients, and you could anticipate that this is going to work out if the croissants that this guy is going to produce or this lady is going to produce is up to a certain quality. And when we talk about venture capital, we talk about disruptive things where you actually cannot predict the outcome.
One of the aspects of venture capital and risk capital, therefore, is basically that you go into it with the expectation that out out of 10 investments that you make, maybe 7 don't pan out, right? So you expect that a lot of them will be wasted.
That's something that you need to have as an assumption, as a theoretical possibility. And actually, I'm investing myself also on the private side into venture capital, because I don't make a real differentiation between what I do privately and what I do professionally. And I invest in life sciences investments, drug development. And there, to a certain degree, you're up against statistical risks, because you know that from 100 molecules that go into clinical trial, maybe 1 or 2 make it to the market. The 1 or 2 that actually make it to the market are those that are going to compensate you for the risk that you're taking, yes.
But do you, when you make those investments privately for yourself, do you go and find the company and say, I'm a venture capitalist, I'd like to invest in you? Or do you go to a venture capital fund? How does someone become a venture capital investor?
Well, actually, I started off very small. I've got the privilege of having a friend who is a scientist and who used to be in scientific advisory boards of a couple of US-based funds. And he got access to deal allocation for friends and family of those advisory boards and passed on some of those tickets to me at that time, which were very tiny investments, basically a couple of €1,000 at the time. And that's how I started off with. And thanks to the insights of my friend, we made that a little bit more and could do bigger tickets. And we had a very big success in 2000. But we invested in 2003, and it turned out in 2007 that it was a huge success. And now I'm basically in the privilege that I don't have to look for the deals anymore, but the deals come to look for me.
Mm-hmm. So you're an angel investor, one of those people that the EIF also invests together with.
Yes, although I do all my investment activity for obvious reasons outside Europe, because in Europe I would be probably conflicted on every single transaction that I would touch, given the size of the portfolio that EIF is running.
Where is most of the venture capital investment? You mentioned there that these were in the US. Where is it easiest to raise venture capital funding if you're a company?
It's probably still true to say that the easiest is in the US, because the entrepreneurial mentality in the investment community is probably the most prominent one in the US. But we have to say that also Europe has caught up quite a bit over the last decade and a half, and has closed to some extent the gap. I think in terms of technology and sophistication of the research and intellectual property that we were producing in Europe, I think we have always had a very good stance in Europe, and in many dimensions probably even a better one than the US. What was missing for a long time in the European context was a kind of availability of this entrepreneurial spirit, both at the side of entrepreneurs but also at the side of investors. In Europe, we had for a very long time the attitude of investors of investing in venture capital by looking for protection against downside risk, losing the money.
Mm-hmm. Mm-hmm.
But venture doesn't function that way. Venture functions because of the asymmetry of the risk and the return that you see. Because if you invest in a company, the maximum you can lose is 100%, which is painful enough, but that's the maximum you can use, that you can lose. The reason why you invest in venture is that you can gain a multiple of the 100% that you put in. Mm-hmm. That not only give you a fair return on the risk that you were taking on the specific deal, but also on all the other deals that you've made that have turned out to be less successful.
So this is what people would call a high growth company.
It's I call them actually. I don't reason in terms of growth when I look at any business. I reason in terms of disruption, and we are living in a period of time where disruption is actually key to the sustainability of our society. We know that we are facing challenges all over the place that we cannot tackle with the type of approaches that we've taken in the past. And for that simple reason, we need to innovate in order to actually overcome the constraints towards sustainable development that we are facing, be it on the side of resources, be it on the side of impact that we have got on our environment, be it on the side of demographic challenges that we are facing. We cannot pretend that we can just do the same thing that we've been doing with a planet of 4 billion people and do the same thing with 10 billion people and see no difference. So the difference is innovation.
With the EIF, or one of the funds that we invest in, is looking for really these disruptive ideas that make the whole world a better place or a more efficient place. And we invest in these companies, and these companies they turn around and they say that, okay, so this idea didn't pan out, but let's use this money instead to do a really nice bakery. How do we protect ourselves against that, or is that fine for us as long as they bring in the financial return?
No, I think when we select to invest in fund managers, that's basically the business model you're referring to. We invest investment strategies. That is something that is defined, even though we do not know what exact companies the money is going to be deployed in. Mm-hmm. We're investing in investment strategies that target a specific field. If I invest in a fund that does life sciences investment, I am fairly certain that I will not end up in a bakery, mm-hmm. but I will end up in something that will look after, if it's a drug development fund, it would look at new drugs and new molecules that are supposed to cure certain diseases. Or if we invest in a medtech fund, they would invest in devices that help the delivery of medications in a more targeted way within the body. Or if we invest in a digital economy transaction or fund, then we would look at transactions that are looking at internet businesses and things like that. So it's that you have got a certain degree of influence in selecting the fund managers and their investment strategy that they're putting forward, and that typically is something that is brought together in the contractual framework that you are mm-hmm. Signing up to when you make an investment, and that gives the boundaries of what you're looking at.
And also, when I imagine a venture capitalist, I imagine this seasoned entrepreneur who's had success in the past with his own business, and who then puts a little bit of money into this young startup, and also in addition to the money, he makes some wise observations and gives some good advice, and that the startup will then benefit from. Do we also do that? So do we just put in the money, or do we also offer them any advice?
Actually, if you look at it at the end of the food chain, an entrepreneur typically does not do his or her business because of money. An entrepreneur is somebody that wants to change the world, and if he or she is successful in it, she will do it again, and that is basically in their DNA. And when they look for venture capitalists that give them money to do their ideas, to bring to life their ideas, they're looking for people that actually can also give them guidance in avoiding the pitfalls on their journey. And there are many of them. And the more you can actually get people around you that help you avoiding those risk elements that you're confronted with in bringing a business from a startup to a kind of global category player or a unicorn of size of Uber or Spotify or Skype and the like. That's something which is a difficult journey where you need a lot of help along the road. Yes.
This is a dictionary of finance, the podcast. So I want to get a couple of terms here and ask you to tell us what they mean and where they fit into the, let's say, the life cycle of a venture capital company. Seed funding, mezzanine financing, and exit.
Okay. Seed funding is basically the first capital that goes into a company. So if you have got a business idea and you've got no money at all, typically you go to people, venture capitalists that are ready to make basically a bet on you. And they tell you, you've got, 50,000 euros. You prove me that your business model is worth something. And then you go off and with that capital prototype your business model, or you kind of create if you do an internet business, you create some market evidence that there's traction in your business model, that somebody actually is using what you're putting into the web. And based on that, then venture capital then will judge whether this has actually the potential of reaching scale, and that will give you different options of getting funded.
So that's the seed funding. Whereabouts in the life cycle is the mezzanine financing, which is a fantastic word. I love it.
Yeah, the mezzanine capital comes actually at a fairly late stage in the development process of a company. It is basically at the point in time where a company is either already bankable to some extent, or at least at the edge of becoming bankable. Mezzanine can help providing funding to a company without diluting too much the ownership. So if, for instance, in the drug development, you've got very capital clinical trial phases that you need to get funded, and if you would fund that all through equity and try to allocate equity shares in return for that, then you might very well end up in a situation where the founding team of that company has very little ownership at the end because they don't put up the money.
So mezzanine, and technically it's equity that can be converted into debt, or vice versa.
Mezzanine is something which is a type of debt product, but has actually a risk profile which is stronger than what bank debt would typically be. So it's in between the two. Sometimes it has equity features attached to it, so that when the mezzanine loan gets repaid, that there is also kind of equity kicker, as we call it, which gives a kind of participation in the equity return of the underlying company.
But it comes from a venture capitalist. It's before the company is able to get bank financing still.
It comes from either from venture cap, but there are also mezzanine funds out there that are specialized in that. It sometimes comes from more mid-market buyout type of private equity funds, and sometimes even banks provide mezzanine capital as a kind of diversified product from their product range.
So then the other term was exit. Where do you get out as a venture capitalist?
Well, as a venture capitalist, there are various ways of getting out to it. The most prominent ones are possibly the listing on a stock exchange, which we call an IPO, initial public offering. Or you do it through a sale of the company, typically to strategic trade sale buyers. And those are the two most prominent exit routes. There's a third one, which is the sale back to the founding entrepreneur, which I think if it may work out in very small scale businesses, but actually if a business grows to a multi-billion dollar company, you will imagine that it's difficult for an entrepreneur to buy the venture capitalist back out.
Mm-hmm. All investments are prone sometimes to bubbles. And I suppose there's a fairly famous one associated with venture capital, which was the internet bubble of the late 90s. How did that happen? And why did so many companies seem to rise in value and get so much investment so quickly? And how did it end?
The reason why it happened is very trivial, because it's like financial markets in general. If there is oversupply of money seeks different channels of being deployed, and if all the reasonable ways of deploying money are exhausted, then unreasonable ways of deploying money kick in. And that's exactly what happened in the turn of the century. In the run-up of 99, 2000, we had so much money in the market that people were actually not screening investment opportunities at all anymore. It was almost enough to write a .com name on a glossy front page of an investment memorandum, and you could get funded, and sometimes funded with very sizable financing rounds. Not very difficult to predict what happened as an outcome of it. At a certain point in time, somebody realized that what they had in their portfolio was not really worth anything, and started to basically sell off, and that actually gave the gave the incentive of others to do the same thing. It's like having this musical chair game. When somebody tries to step up, everybody wants to secure a chair too and not be the last one standing. And that's what happened in that market, and actually it just spiraled downwards and the market collapsed.
Do you think venture capitalists learned a lesson there, or could that happen again?
That definitely can happen again, and I would even say that it most certainly will happen again, because I don't believe very much in financial markets intelligence.
So now we know all about elephants, and venture capital as well.
Yes. So thank you for joining us for another episode of A Dictionary of Finance. Please join us again next week when we tackle further terms and concepts used in finance and in banking that you might not have heard about before.
And you can get in touch with us on Twitter and say, hey, at EIB Matt, M-A-T-T, you should be going into this particular term, whatever it is. As long as it's short enough to fit in a tweet, it's short enough for us to do an entire podcast on it at EIB Matt or
at Allar Tankler, ALLARTANKLER. Also, please do subscribe to our podcast and rate us if you're going to rate us positively. And see you again next week.